Tom, thank you for joining us. First off, let's talk about the portfolio. What new companies have you been buying and selling?
Well, to the theme of secular growth, I mean, where are there areas where we have long-term growth? Well, I think online retail, online advertising, consumption in emerging economies where the consumer is still a low percentage of the economy. These are long-term themes. One company that we bought relatively recently is Delphi Automotive. It sells components to all the large automobile manufacturers in the world. Now, clearly, auto manufacturing is pretty cyclical. What's attractive about Delphi is that it's pursuing three major long-term themes, which is safe, clean and interconnected. So it's doing more and more components for cars to make them safer, driver assistance systems, to make them cleaner, obviously for the environment, and to have better infotainment systems. And as we move towards more electrical vehicles, it's going to have more and more components. So even if there's a mild downturn in the auto cycle, we think that a company like Delphi Automotive can continue to grow.
So it's hooked into the long-term trends. Now, talking of a business that's been hooked into long-term trends or even arguably setting them, Apple is one of your top 10 holdings. First decline in earnings for many years. What do you think the outlook is there?
Yes, we've held Apple through thick and thin, mostly thick, for many, many years in Martin Currie Global Portfolio Trust. Clearly, growth gets harder as the company gets to the size that Apple is. And in the current fiscal year, yes, we're going to see an earnings downturn, 11-12% decrease in earnings. But our view is that this is very much a product cycle. The iPhone 7 has literally just been launched, and early indications are that it's doing well. And we expect to see high single-digit, low double-digit earnings growth from Apple for the next couple of years, so that this current year where we're seeing an earnings decline is a bit exceptional. The Apple ecosystem has got so many consumers hooked into it. It has such a huge installed base now that we're pretty confident that as long as it continues to innovate, not only will iPhones do well, but many of their other applications and music systems and so on will continue to offer growth too.
What are you looking for in stocks at the moment?
Well, I like to find a secular growth theme or trend, but then beyond that, we do a lot of our own proprietary research. We do 5-year detailed forecasts of profit and loss account, cash flow, balance sheet, and really try to get a feel what the valuation of company is going to look like in the long term, the 5-year view. So what's this company, what sort of share price can this company justify in 5 years' time, driven by growth in earnings, cash flow, good capital allocation by management. So we spend a lot of time talking to management, spend a lot of time on environment, social and governance issues, and really getting a feel for how they're allocating their capital. But an example perhaps would be Visa, which we bought fairly recently in the portfolio. What the context for Visa is that the payment platforms are gaining market share, cash and checks still about 85% of global transactions. Obviously with the growth of online retail, debit and credit cards is gaining a lot of share in that. Visa is twice the size of MasterCard, and there are a number of specific issues that our analysts have picked out for Visa where we think we have insight. They've just bought Visa Europe. We think there's huge synergy potential, margin enhancement potentials from that acquisition. So Visa is a company we think can grow its earnings at about 20% per annum for the next 5 years.
There are those out there, though, aren't there, saying that equities in general are hugely overvalued, that they've actually lost touch with reality on a risk-adjusted basis. What's your view on that? What would you say to those commentators?
Well, I hear that. Most people are comparing absolute valuation levels, but we're in an environment we haven't been in for decades with very low interest rates. And I think it's a nonsense to look at equity valuation in isolation. You really have to look at the risk-free rate, so typically the 10-year government bond yield, to compare the valuation of equities and alternative asset classes. And I think on that basis, equities remain good value. I think for the next 5-10 years, we're not going to see a lot of growth. That is a challenge, but the value I'm more comfortable about.
Turning to emerging markets, you have a low weighting in emerging markets. Is that going to continue? What's your view there now?
Yeah, I mean, I think in emerging markets, it's not really one asset class. It's dangerous to talk it as one asset class, and I know it's convenient to do so. But to me, some of the Latin American economies, which have benefited recently because of the bounce in commodity prices, to me, they have significantly greater problems than perhaps some of the emerging economies in Asia ex-Japan. So I have exposure in Martin Currie Global Portfolio Trust to Indonesian companies. These are companies, a retailer and a conglomerate, benefiting from an economy which is definitely recovering after a few difficult years. We have some exposure in Taiwan. I have no exposure at all in Latin America, and I think one has to be very selective, not just by country, but obviously ultimately by company.
And in terms of the UK, some positive data recently. Is this a false calm before the storm, do you think, or are we okay?
Yeah, I don't have much exposure to the UK. I mean, I have 11 or 12% in UK quoted companies, but if you actually look through those companies, many of them are global earners and some have very little earnings in the UK. But as far as my view in the UK is concerned, I do think there's a bit of complacency. I mean, we haven't. Article 50 is miles away from being invoked. Negotiations have not started at all on how we get out of Europe but maintain access to European markets. So to me, and I'm not a politician, but I can see no upside for Europe to give too many concessions to the UK because they're going to just bring on more trouble for the European Union. So I think there is a bit of complacency. That said, in Martin Currie Global Portfolio Trust, the UK economy per se is not a big driver of asset and share prices.
And just looking to the end of the year, markets have shown more volatility since the end of the summer. Are you concerned that a retreat is around the corner?
Well, markets have had a huge move. I mean, Martin Currie Global Portfolio Trust NAV move per share moved up over £2 after the Brexit vote in June to new record high levels. Indicating markets have been very strong. We've benefited hugely in global equities from the weakness of sterling, which occurred after the Brexit vote. So I think it's dangerous to say equity markets have been very, very strong. Actually, sterling's been very, very weak, and that is where a lot of the strength for UK-based investors has come from. That said, there isn't a lot of growth out there. We've had a nice run in market. These things don't tend to go up in a straight line, so some down days, some down months, one could certainly expect that. But my medium to longer term outlook is that global equities remain a pretty good place to be for long-term investors, and that probably over the 12-month and beyond type outlook, it's still a good place to be.
Well, there's certainly been no shortage of news this year for markets to digest. Tom, thank you very much for joining us.
Thank you.